So technology stocks have been on a pretty crazy run this year. With the world beginning to move towards remote working though, it's not much of a surprise that tech has performed so well. However, when you see things like this chart, which shows how Apple, Facebook, and Alphabet, the company behind Google, they've grown so much over the course of 2020, massively outpacing the general market index, it does make you question, has tech in 2020 already seen most of its growth? So in this video, I'm going to be looking at the opinions of a few experts and giving my less educated opinion to try to answer the question that you may be wondering. Will tech stocks continue growing for the remainder of 2020? Or is their rapid growth simply unsustainable? To be clear, this is not financial advice, and I am not a financial advisor. Like you, I am just a regular guy researching this stuff, as 2020 has been a crazy year so far, and it's been very confusing for me too. This video is just me sharing my personal research with you. Okay, so let's get straight into it and let's put forward the arguments for why tech stocks still have more room for growth. First off, the sentiment among hedge fund managers has changed over the past few days in a dramatic way. After establishing one of their biggest short positions in US tech stocks in more than a decade earlier this month, hedge fund managers poured their money into NASDAQ futures at a near record rate. In other words, after the recent incredible run for tech stocks, hedge fund managers had been betting on the stocks dropping in value. And they've been doing so at an incredible rate, in fact the highest since the last financial crisis in 2008. More recent data has emerged though, which shows that this has flipped and hedge fund managers are now betting on the value of tech stocks to rise. In fact, the reversal left speculators net long technology stocks for the first time since the beginning of September. So this is the first time since September the hedge fund managers overall have been betting on tech stocks rising further. The second driving force behind technology performing in the long term is the push towards remote working. Over the last decade, we've seen that remote working jobs can work very well for businesses, but we've never before seen it on the kind of scale that we now have it over the course of 2020. This year, we've seen the likes of Shopify going all in on remote working, saying, I don't think there's a going back to the office the way we had. Twitter has said that they'll allow certain positions to work remotely forever. And these two companies are just part of a long list of companies who are going to at least incorporate remote working. Whatever happens, it's clear that remote working is here to stay. And 2020 has been a huge leap forwards in that long-term trend. As a result, the reliance on technology to coordinate employees, it's dramatically increased, and therefore you could argue, so should the value of companies providing these solutions. The third driving force is that technology is seeping into every sector and just fundamentally changing many industries forever. So you might have heard of Cathie Wood, either from TV or maybe even from my channel. She's been the most successful investor in the public markets since her fund ARK launched in 2014. Here's a short clip of her explaining things.
Technology is seeping into every sector, so it's blurring the lines between and among sectors. So a stock like Tesla, now being analyzed in the traditional world by auto analysts, which are analysts focusing on a very mature industry. They're value analysts, right? So price to book, dividend yield, all of those metrics are important to them, are going to find it difficult to analyze a company that is not just an auto manufacturer, but also an artificial intelligence chip designer, and an autonomous taxi platform provider, which is a transportation as a service. So we've got three analysts focused and collaborating on understanding how Tesla is going to evolve during the next few years.
So she gives the example of Tesla. Tesla are quite a controversial topic sometimes, as people, they love to debate the stock price, but let's just forget about that for a second. Instead, let's just think about what it is that they're actually doing. They are designing self-driving cars. Not just regular cars, self-driving cars. Once they have cars on the road that don't even need a driver in the front seat at all, that's going to change the face of many industries, not just the car industry. When Amazon started, they just sold books online. Over time though, they've grown their inventory of products, and now they even sell groceries. In technology, there is this idea named Amara's Law, which is named after Roy Amara, and he said that we tend to overestimate the impact of a new technology in the short run, but we underestimate it in the long run. So the third driving force, and the big question when we're asking ourselves if there is still room for growth in technology stocks, is how large is the potential market for technology? Because historically, people have underestimated the potential market size of technology companies. Amazon started out as a competitor to just bookstores. Now they are a competitor to just about every type of store. It looks to me like people are still underestimating the potential for technology to disrupt industries. Just because an industry hasn't been disrupted yet, it doesn't mean that it won't be. As technology seeps into every sector, the potential for growth is actually very difficult to even quantify. We also have famous investors like Howard Marks, the co-founder of investment firm Oaktree Capital, saying in a recent memo to clients, the measures of how expensive tech stocks are relative to current profits could actually understate the potential growth of these companies because they spend so much to drive their rapid growth. Technology companies are famous for reinvesting a large portion of their profits in order to drive innovation and grow rapidly. But here's the thing, I could sit here and just give you one side of the argument. In fact, it's actually much easier for me to do just that in these videos, especially as I think most of you watching this are probably, like me, invested in tech companies. However, I don't feel like it's really the right thing to just do that. My job here is to educate you, so you can go away and research this stuff more for yourself. The only way I can really do that is to provide you with both sides of the argument, because not everybody agrees when it comes to tech stocks. In fact, if we go back to our chart from earlier, remember how hedge fund managers are net positive for the first time since September? Well, while that is true, this is what happens when we wind the clocks back to just before investors swung positive. The number of investors betting on tech stocks to drop was at record levels since 2008. So while investors may be betting that the market is going to rise now, this goes to show how quickly and how dramatically they can change their minds. There's also the argument to be made that a strong recession or even a depression will eventually seep into the technology sector too. So at the start of 2020, many of us were locked in our homes, and at the same time, governments worldwide began sending out money, such as the furlough scheme in the UK or the $1,200 stimulus checks in the US, along with increased unemployment benefits. Now, if people have a similar amount of money to what they had before, and they're locked in their homes, and we know that most people have a spender's mentality, well, it's not exactly a surprise that companies like Amazon were shipping more products than ever. Or people had more free time, and so they were watching more YouTube videos. But what happens if the recession continues for longer than people expect, and if governments aren't able to provide enough stimulus? As things like furlough schemes or higher unemployment benefits begin to wind down over time, more and more people are going to be faced with the tough reality of struggling to make the important payments in their life, such as their mortgage. In recessions, people tend to spend less. Over time, that could translate to companies like Amazon making fewer sales. As people buy fewer products, traditional companies may also struggle, meaning they have less of a budget to advertise on platforms like YouTube, Google, or Facebook. Less advertising means lower income for those technology companies. Lower income means their share price could drop. Or they'll have a whip round of our most sensitive data and sell it to the highest bidder. Kidding. Kind of. When we look at the valuation of tech stocks, you might also be surprised by just how much they've risen in value this year. So you've probably heard that the stock market has done surprisingly well so far in 2020. It's kind of crazy to say, but at the time of recording, the S&P 500 is up 5% for this year. With the S&P 500 being a measure of America's 500 largest companies, this gives the impression that the average company is up 5% this year. However, that's not quite true. The Dow Jones is another measure of America's top companies. This time, it's 30 of America's largest companies operating in more traditional sectors. Surprisingly, These companies are down 2% on average for the year, and the Dow Jones actually includes Apple. Without Apple, this would make for far more grim reading. This is in complete contrast to the Nasdaq index. The Nasdaq index is a broad index for how technology is performing, and as we can see, it has performed much better than the two other indices that we looked at before. Tech companies are up this year an astonishing 26% on average. So even though you may have seen that stocks in general are up for this year so far, the truth is the majority of stocks are actually quite significantly down. It is primarily tech companies which have been single-handedly dragging up the market in 2020. So, what does that mean? Well, it means two things. It means that technology companies are taking up a larger and larger portion of the overall market. This chart shows us the percentage of the market that is made up by technology companies. Specifically, have a look at the red dots. Back in the late 90s, technology dominated with roughly 36% of the market. Of course, the dot-com bubble burst and the numbers began to fall. Between the low of 2005 and 2015, there was growth, but only by around about 5%. Between 2019 and 2020 alone, just this last year, however, there's been a similar 5% growth. In fact, technology now dominates nearly 40% of the stock market. So that creates the age-old thought in our minds of what goes up must surely come down. Now, I don't think there's much question, in my head at least, that technology, to be fair, will continue to grow year on year in terms of stock market dominance. So in the long term, it probably actually won't come back down. But the real question here is, with the growth in tech's dominance being so rapid over the past 6 months, has the growth been too quick? Maybe it's due a pullback. The final major concern relates to government intervention. Jacob Walthour, chief executive of Blueprint Capital Advisors, notes that the only thing that really worries me as a tech bull is the likelihood of government intervention. Amazon and other large internet companies have come under increasing regulatory scrutiny in recent weeks, with a Democratic-led House of Representatives panel recently finding that Congress should consider forcing the tech giants to separate their dominant online platforms from other businesses. However, few analysts expect the biggest tech firms soon to be broken up, and regulatory actions are often slow to play out. But many investors think regulation could be another source of volatility in the weeks ahead. So there you have it. You have the arguments for and those against tech stocks at the moment. Like I say, it is easy to really only present one side of the argument if you choose, and you often see that with traditional media, but I think you deserve to hear both so you can make a truly informed decision. How do I personally see it? Well, if you're a subscriber, you'll know that my stance on investing is always for the long term, and I like to be well diversified. When I look at the technology sector and I ask myself what I think is going to happen in the next, say, 5 to 10 years, I believe the dominance in the market is going to continue growing. I believe that technology will continue seeping into every sector, expanding the potential market size for technology companies above and beyond what it already is today. In the long term, it's fair to say that I'm definitely bullish on technology. When it comes to the short term, well, I tend not to think about it, to tell you the truth, as I am so focused on the long-term outlook. But if I was pushed, I would say that there are strong fundamental reasons why tech companies have grown, such as the drive towards remote working. And I think that these fundamentals are not going away anytime soon. In fact, probably never going away. A low interest rate environment is also very bullish for stocks, but particularly for tech stocks who can borrow at cheap rates and fuel their growth above what regular companies can. However, the rate at which tech companies have grown, it doesn't appear sustainable, and I do have concerns about how a long recession would ultimately affect their income. As I've said for many months, I've never really bought into the idea of a V-shaped recovery, and I think it's going to take many years before the economy does fully recover. So I do think there has to come a time when tech stocks reflect reality, and that means a dip. But again, as an investor, my focus really is just on the long term. So if you want to see more videos like this twice a week, make sure to subscribe and turn on notifications. Before you go, check out this video up here for another video that I'm sure you're going to enjoy. And of course, thank you for watching.